Hello. Hello. Can anyone hear me? Can anyone hear me? If you can hear me, drop a chat. Say I can hear you. Okay. Great. I can see. Yeah, you can hear me. All right. Timmy Lyle said we can hear you. That's great. That's great. Yes, yes. Okay, keep it coming. Keep it coming. Okay. Great. Great. Yeah. I can hear you. I can hear you. Awesome. Awesome. I can see you. I can see your chat too. Yes, my name is Tumishe Olaolua from Nigeria. Um, and it's fantastic to be here with you all on this very interesting topic we'll be treating today. Yeah, so my name is Tumishe Olaolua, as I've said earlier, and I've been trading forex for the past 5 years. I also have diverse experience trading stocks, trading currencies, trading cryptocurrencies. That's features basically, and many others. I also have interest, and I work as a data analyst. Yes, so today I will be taking us through candlestick charts. How does it work, and what time frame to choose? So it's very interesting topic, because we need to understand how does candlestick charts work, and what time frame do you choose. Yes, so I'll be going through this topic today. Yes, but before I continue, I would like to know where you are from. So let me know, where are you from? You can drop it in the comment section. Where are you from? Where are you listening and watching this webinar from? And how long have you been trading? Where are you from? And how long have you been trading? All right. Yes, let me see. Let me see the charts coming. Where are you chatting from? I've told you I am Tumishe Olaolua from Nigeria. So let me know where you are chatting me from. Let me know where you are watching this webinar from. Okay. I'm waiting. Where are you watching this webinar from? Okay, while I'm waiting for you to give me a response, just tell me where you are watching the webinar from, and how long have you been trading forex. Yes, so you need to know that for attending this webinar, after this webinar, there is 100% 100% deposit bonus for you. Yes, for attending this webinar. We give this bonus to everyone who has signed up for the webinar on our site, and the link is in the description. You can check the description below and attended it. So if you attend this webinar, you are entitled to this 100% deposit, 100% bonus deposit. So to take advantage of this, make any deposit, and check that you want to apply the bonus. So if you want to apply for the bonus, apply for it before 22nd or on or before 22nd of April, because it will be expiring on the 22nd of April. You don't want to miss this. So you don't want to miss this. Great. So today we are looking at candlestick charts. How does it work and what time frame to choose? Awesome. Now, what do you understand by candlestick? Because it's very important for us to know what candlestick is all about before we could dive into the chart to know what details the candlestick is communicating to us. So the candlestick chart have enjoyed continued use among traders because of the wide range of trading information they offer, along with design that makes them easy to read and interpret. So the candlestick chart, passes an information to traders, and it's quite easy to read and interpret, and that's why we are here to teach you so that you can read it and interpret it alongside with the time frames. So on the chart, each candle indicates the open, high, low and close price for the time frame the trader chooses. So I would show you my chart and explain more better to you, but then you need to understand this, that on the candlestick we have the open price, we have the high price, we have the low price, and we have the close price. So I'll be explaining them in details as we proceed further in this webinar. Now, for example, if a trader sets the time frame to 5 minutes, a new candlestick will be created every 5 minutes. So if you open your chart and you pick the 5-minute time frame, a new candle will be formed every 5 minutes. So the first 5 minutes, the next 5 minutes, another new candle is formed. The next 5 minutes, another new candle is formed on a 5-minute time frame. So for intraday traders, for intraday traders, the open and close price are those that begins and end in every 5 minutes period, not the trading session. Okay, now let's talk about the anatomy of the candlestick chart. What does the candlestick chart entails? What are anatomy? Now on the candlestick chart we have the open price. The open price, the top or bottom of the candle body, will indicate the open price depending on whether the asset moves higher or lower time frame. Now we are taking the 5-minute frame as an example here, though I would show you different time frames across the chart. Now the high price during the candlestick period indicated by the top of the shadow. I will explain to you with a pictorial view soon. Indicated by the top of the shadow or tail above the body. Now the low price is indicated by the bottom of the shadow below the body. Now the close price is the last price traded during the candlestick. It's indicated either at the top for a green or white candle, or at the bottom for a red or black candle. Okay. Can you hear me? I would like to know if we just drop a chat. Let me know if we are still following. Okay. Now, from this pictorial view here, this shows the anatomy of a candlestick. Now, from this place, I would see that this upper shadow here, this thin line indicates the upper shadow. So for a green candle, which is referred to as the bullish candle, and the red candle, which is referred to as the bearish candle. Now on the bullish candle, because in the bull market, price the market is going high, the market is moving higher. Now in the bear market, the market is moving lower. Now in a bullish candle, the candle opens below and closes above. The candle opens below and closes above. Now when the candle opens here, it moves down lower to this low to create a low. But at this point here, this thin line which is called the lower shadow indicates that the price was rejected at this level. So this lower shadow indicates that what price got this low but was rejected back up to this level, and price went as high as this level, which is our high price, and created the upper shadow. Then the price was rejected down to this level and it closed at this level. So here on a bullish candle, the market opens and went low, but there was a rejection at this place, and that is why we see this thin line which is called the lower shadow or the wick being created. Now when this wick being created shows that the price was rejected at this level and it went up to create a high, and also was rejected at that same level too. It was rejected at this level and came down to this place to close. So we have the real body. The real body is between the open price and the close price. The real body is between what? The open price and the close price. This green candle is always seen when the market is rising. When the market is rising. Don't forget, this low price here shows that what is called lower shadow, shows that what the market rejects the price at this level, and that's why this lower shadow was created. It's only an indication that there was a price footprint at this region. That's why this lower shadow was created, and then it went up and the price was rejected at this level again, and then it closed at this level. So this high price is what we call the upper shadow. It creates the upper shadow, and this low price creates the lower shadow. Now same thing applies to the bearish candle, but the other way around. For the bearish candle, because when the bearish candle appears, it indicates that the market is going down. When the bearish candle appears, it indicates that what the market is going down. So when price opens at this place, when price opens here, because in a bearish market, price opens above and close below. Price opens above and close below. In a bullish market, price opens below and close above. Are we following? Price opens below and close above. In a bearish market, price opens above and close below. So if you see it at this point here, when price opened at this level, it went up to create an high, but the market was rejected. The market rejected the price at this level, and it came down to this level, to the low, and the market rejected it again at this level and closed here. Now this point of rejection is what we call the lower shadow. Do you get that? Now this point of rejection is what we call what? The lower shadow. This point of rejection, we call it the lower shadow. And this point of rejection, we call it the upper shadow. Now let me take my pen. Okay, good. So at this point here, we have the upper shadow and the lower shadow, as you can see. So the price opened at this level, went up, market rejected it, it created a shadow, came back to the original opening price, and went down, went so low to this level, and then market rejected the price at this level, came back to this price point and closed here. So at this point it closed, it opened here and came down to close at this level. Now, as I said earlier previously, the other time, I said the body, the real body is between the open price and the close price. Now, the body of a candle also determines the strength of the market. Note that the body of a candle determines the strength of the market at that moment. That's one thing you need to understand about. That's why you need to understand the candlestick, because the candlestick communicates the language of the market to us. So if you want to understand the language of the market, you need to understand candlesticks very well. You need to understand candlesticks very well. I would do a quick recap, which I'll start from here, from the bullish candle. When you see the market rising, now when you see a green candle, it's indicating that price opened below and closed above. Now when you see a shadow, either an upper shadow or a lower shadow, it's an indication that the market rejected the price at that level. So which means this candle should have come here to close below here, but could not close at this level because the market doesn't allow it to close at this level, and rejected the price back to this level and it closed. So every shadow, either upper shadow or lower shadow, is an indication of price rejection. And the body of a candle also indicates the strength of the candle. If it's a bullish candle, if it's full bodied, you then know the market has a more higher tendency of moving higher. If it's a bearish candle with a full body, you know that the market has a higher tendency of going lower. Great. So I will take us on the next track. Now let's talk about price direction, because that is what the candlestick communicates to us. The candlestick tells us where the market is going. It's a pointer. Let me put it like that. It's a pointer. Either the market is going higher or the market is going lower. Now, price direction. You can see the direction of the price movement during different time frames using the candle. So when your bullish candle is indicated either by green or white, and you see it moving higher, then you know the market is going higher. Your bearish candle, which is either indicated by red or black, you see it going lower, then you know, okay, the market is going lower. Now if the candle is green, the market price closed above where it opened. And if let me show you an example from my chart. Okay, I believe we all can see my chart. Can you all see my chart? All right. Now let me zoom in on a particular candle. Great. Awesome. Now if you look at this candle here, okay, let me adjust. Okay, now this makes it more clearer. If you look at this candle here, now you see that when I place my cursor on the candle, it shows me the open price, the high price, the low price, and the close. Now what I'm saying is this: you see, when the market starts rising, you see that you see more of a green candle than a red candle. This shows that the market is in in a bullish run. Are you with me? Now, in this case where the market is going down, as you can see, the market is going down. This is a bearish market. You would see more of the red candle. See, the market is going down. The market is going down. You see more of the red candle. When the market is going up, you see more of the green candle. Because look at it. When the market is going up, you see more of the green candle. Because the green candle indicates the bullish market. And if you look at this one, you see predominantly red candles. Now, this also indicates that the market is going down, the bearish movement, the bearish market. At this point, you see that the market is going up, showing a lot of green candle. That's the bullish market. Now, you see that the candlestick tells us the price direction. So when the price is coming down, a red candle, is indicated. A red candle shows up, indicating that what the bear market has resumed its activity. So now you see the bears pushing down the price, and you see a lot of red candle. So this candlestick is showing us the direction of the market. Now, when the market took a reverse, at this point, you see predominantly green candle. Now, which tells us more that what the market is going up. We are now in a bullish market. You see predominantly more of green candles. At this point here where you see a lot of red candles, it's telling you the price direction is going down. At this point where you see a lot of green candles, it's telling you the market direction is going up, is going higher. Do you get it now? So the candlestick is used to detect or know the direction of the market. Do you get that? Great. Now let's talk about the price range. The price range. Now, the price range is the distance between the top of the upper shadow and the bottom of the lower shadow. That is called the price range. The distance between the top of the upper shadow and the bottom of the lower shadow is known as what? The price range. The price range between different time frames. Now, if you see from this picture here, that this is day one. This is daily time frame. Now, I just use that as a better example. I will show you in the chart soon, but let's check this out. Now, if you see, this is day one, daily time frame, then day two, and then day three. Now, this price range tells us the distance between the upper shadow of a candle and the lower shadow of another candle. Now, if you look at it, this is the upper shadow of this candle, and this is the lower shadow of the same candle. Now, then you come here, this is the upper shadow of the day two candlestick, and then this is the lower shadow. Then for the third day, this is the upper shadow of the day three, the third day, and then this is the lower shadow. Now, this passes a lot of message. When price moves from this level, let's say from 300 down to 150, and then the next day price opened at 200 and closed at 400. Then at the next day price fell down to 200, opened at 200 and closed below 100. Now, the range is calculated by subtracting the the low price from the high price. Now you want to know that how far was the distance between the high price and the low price. Don't forget, the high price and the low price are those levels created by shadows. So now this upper shadow, we assume that okay, this upper shadow opened at 300 and closed at 150. So we say, what's the price range of this candle, which is 300 minus 150. Do you get it now? So this price moved below by additional $150. Do you get that? Now let's go to the day 2. When the market opens on the day 2 at let's assume 200, then closed at 400. Now the price range, we now say 400, which is the high price, this level at which the market got to and was rejected. The high price, okay, we say 450. Then the low price, we say 200. So 450 minus 200, that's 250. So you see that what the price, the candlestick moved higher by additional $250. Do you get it now? That's how to calculate the price range. You subtract the upper shadow, the price of the upper shadow, from the price of the lower shadow. Now let me take you down to the chart so we can okay, great. Now let's go to the daily time frame. Okay, now as you can see here, you would see we have I, that's of this candle, the daily time frame. Let me zoom it closer. Okay, let's use this bullish candle. Now you can see that from this candle here, okay, yeah, good. Then we put this here. Okay, good. Okay, beautiful. Now we want to look at the price range of this candle, this particular green candle that I have my arrow on. Now from here we see that this candle opened here. This candle opened at 1.17944. The candle opened at 1.17944. Yes, you can grab your calculator, so you just get it like that. The price opened at 1.17944, and this is lower shadow, which is the open price. That's 1.17944. Then the upper shadow is quite small, but that's 1.18781. Okay, yeah, 1.18781. Now we can see that this price changed by 0.00837. So that is the price range of this candlestick, this particular candlestick. Great. All right, let's move to the next slide. Now, what time frame to choose to understand market movement better, and make more realistic forecast? Now, how do you understand the market movement better and make more realistic forecast? Now, using time frame. different traders prefer different time frames. So traders use the monthly, weekly, daily, 4 hours, hourly, 15 minutes, 1 minute time frame to trade. Ideally, traders pick the main time frame they are interested in and then choose a longer or shorter time frame to complement the main one. Yeah. So personally, I use the higher time frame, to analyze the market and execute my trade on a lower time frame. So I would show you through the chart. So we'll take a trade practically. But let me show you through the chart. So we go through. Okay. All right. Now, taking the Euro USD as an example. Now, you would see from the Euro USD chart. Okay. Now, you see from the Euro USD chart, this is the daily time frame. Yeah. Now, you see that on the daily time frame, the market is on a bullish momentum. It's rising. The market is rising. Now, let's go on the 4-hour time frame. On the 4-hour time frame, something is quite different, because on the daily time frame, it shows that what the market is rising from this level down to this level. Shows that the market is rising. Now, on the 4 hours time frame, it's telling us a different story. Now, how do we know that? You see that on the 4-hour time frame, you are seeing something different. Like the market is pointing to the downward direction, from here. Now, you want to look at different time frames to tell you what to do. When you go to the 1-hour time frame, the 1-hour time frame is telling you that what market is rising from the 1-hour time frame. Look at it. Then on the 30-minute time frame, it's telling you that okay, the market is rising. Now, on the 1-hour time frame, it indicates that what on the 15-minute time frame, it indicates that what the market is also rising, but towards this end here is giving us some very unclear direction. So one thing I need you to understand when it comes to time frame is that the lower the time frame, this is just a fact. The lower the time frame, the less significant the strength of the candle. The lower the time frame, the less significant the strength of the candle. So, like this is 5 minutes. You accept you want to scalp the market. There are some traders that scalp the market. They just come in and go out, in a very short period of time. So, but aside from that, you won't want to take a candlestick at this region, to determine your trade. You won't want to use a candlestick on the 5-minute time frame to determine the direction of the market. So personally, I come from the monthly time frame. Now, this is the monthly time frame. Each candle on the monthly time frame, it indicates a month. So each candle here is a single month, is formed in a single month. So which means we are in the month of April. The market is still moving. So the market has opened below at this level. And is moving up to close above. At the end of this month, we would know if the market will close above or will drop. Now, but from here, the second candle, which is the month of March, The market opened at this level and closed at this level. So the market opened at this level, right? Opened at this level and closed at this level. And closed at this level. That's for the second candle, which is the month of March. Then the third candle, the month of February. Then the fourth candle, the month of January. The fifth candle, the month of December 2020. So each of these candle on the monthly time frame indicates how price opened and closed in 1 month. So here is it. Currently we are in March, we are in April, which is the last candle, and it's still forming. So then I come to the monthly time frame to look at what the current and the previous candle are saying, and the current market direction on the monthly time frame. Then I move to the weekly time frame to know, okay, what is happening in the weekly time frame. Now, each candle on the weekly time frame is formed in 1 week. So the current candle is the candle for this week, which opened below and is still currently moving. And is still currently moving here. Now, for last week, we had a very strong bullish candle. Can you hear me? Good. Now, we had a very strong bullish candle. Okay, someone said interesting lecture so far. All right, great one. Yeah, so this is a very strong bullish candle. This is passing a different message from this single monthly candle. Now, which means in this monthly candle, you will see several wicks there. And if you go to the weekly time frame, each candle on this weekly time frame is formed in 1 week. So before you want to make your trade decision, you want to ask yourself, what did the market, what candlestick was formed last week? What candlestick was formed last 2 weeks? Or what is the market direction in the weekly time frame? Now, that will guide your judgment to know what direction you want to position yourself. Then you might now decide to go lower to the daily time frame. Now, if you go to the daily time frame, each candles on the daily time frame is an indication. It indicates that each candle is formed in a day. Now, if you come here, now each of these candle, which is, as we are talking today being 15th of April 2021, this is the candle that is currently forming. This is the candle that is currently forming right now. This candle is the one that is currently forming right now. Now, yesterday, this was the candle. Now, you could see that price opened at this level. There was little or no wick or shadow to there is no lower shadow on this candle, the candle that formed yesterday, because we are on the daily. The candle that formed yesterday, there is no lower shadow on it, but you will see that there's an upper shadow. Then price moved up, created a shadow, then the market dragged it down a bit to this level. Now, this still indicates a lot of bullish momentum. Then you see this candle. Yes, let's take this one, this bearish candle. Let's take this bearish candle. You could see that it has a very long upper shadow. Very long upper shadow. Now, this can mean a lot. Now this shows that the price opened, because of the bearish candle, the market opens above. You get? Now, the market opened at this level. Opened here. And then went up so high to the high price. And then market rejected the price and rejected it so low down to this level. Now you can see that the real body is very tiny, right? The real body is very tiny. Now this tells us a lot. For a tiny body like this, we want it. It tells us that what the bears, which means the sellers, were very active on this day, rejecting the price so low down to this level. Down to this level. So creating a very long upper shadow. Are we getting me now? So this is how you interpret different candlesticks using time frame. Now let's go to the 4 hours chart. Now if you can see that on the 4 hours chart, look at the current candle that is just forming. We can see that market opened below at this level. Market opened below at this level. Let me okay. Market opened at this level. I'm talking about this current chart, this current candle that is just forming. Market opened at this level, went so high to this level, created a high price which has now become an upper shadow now, and then market rejected it so low to this level. Now I will tell you something here. There are two things that would most likely happen here, and the thing is that this price has a higher possibility to keep going down. This candle has a higher possibility. This price has a higher possibility to keep going down. Why did I say that? Good. Now let's look at the second candle before the current candle. Look at it. The second candle before the current candle. If you see the second candle before the current candle, you will see a very strong bearish candle. Bearish candle. Do you get that now? And what did I say about a bearish candle? I said that what a bearish candle indicates that what price is falling. The market will be going down. Now price opens above and closes below. Now you would see that when price opened above here, it tried to go higher. Do you see that? When price opened above, its price tried to go higher. Do you get it? When price opened here, it tried to go higher to this level. It got here, but the market rejected it and created an upper shadow. Now it came back to the open price and went so low down to this level to close at this level. Now as we can see it now, as it closed at this level, you'd see that it's an indication that what the market is going down. Now another indication that there is a higher possibility that the market will keep going down is because this candle closed below. The close of this candle's price is far lower than these other ones. The first three candle before this second candle. Now you will see that this green candle here opened at this level and closed at this level. Could not go higher than this. Price rejected it, and the market rejected the price. Now this bearish candle came and was formed here. It opened above and closed below. Then this bullish candle came and opened below and closed above with a upper shadow. Now the second to the last candle opened above, went higher, but was rejected and closed far below these other two candles, as you can see. Now let me show you that these other two candles closed around this price range 1.19701, but this second to the last candle closed at 1.19576, which shows that this second to the last candle closed far below the other two candles before it. Now the current candle that is just forming is now showing a very huge sign of rejection. It went up as it first opened as a bullish candle. It went up and market rejected it so much, and it's down to this level now. Now if this candle close at this level, right, there is a higher possibility that there will be a continuous fall of this price. There will be a continuous fall in this market. Probably to a level down here. The price might fall from this level down to this level and either continue going down or correct itself back up. But from this, what this candlestick has communicated to us is a loud message. It's telling us that this bearish candle is telling us that the bears are more powerful in the market currently, and this is a 4-hour time frame. The bears are more powerful in the market, because it closed far below the previous two candles and also closed with a little or no lower shadow. You can see there is little or no lower shadow. That is it. Now let's go to the 1 hour time frame. Don't forget, this is the 4 hours time frame, which means each candle on this 4 hours time frame was formed every 4 hours. So this red candle here was formed in 4 hours. It took 4 hours to form this candle. Then this green one, it took 4 hours. Each of these candle on this chart, it took 4 hours to form this candle. Now that's to tell you that let's leverage on this second to the last candle, because this current candle is still forming. Let's use the second to the last candle. Now that's to tell you that this second to the last candle on the 4 hour time frame, on a 1 hour time frame, is 4 different candlesticks that make up this 4 hours candle here. So now let me show you something. So we are going to look at the next 4 candles after this one in a 1 hour time frame. So let's come here. So good, this is a 1 hour time frame. In this 1 hour time frame, each candle on this chart tells us that each candle is formed in 1 hour. Each candle is formed in 1 hour. So this is the current candle that is just forming now. So 1, 2, 3 is still forming the current candle. Now this on the 4 hours time frame, this bearish candle is this 1, 2, 1, 2, 3. This bearish candle here. So this, because on a 4 hours, it will take 4 hours for one candle to be formed. On a 1 hour, it will take 1 hour for one candle to be formed, which means every four candles on the 1 hour time frame makes up a single candle on the 4 hours time frame. Do you get that? Every candle that is formed on the 1 hour time frame four of it makes up a single candle on the 4 hours time frame. So as I said, that this bearish candle, this second to the last bearish candle, is these 4 candles, below these previous 2 candles. So this is an indication, this candle, this region here, this candle here, it's an indication that the market is changing its direction. So this candle 1, 2, 3, 4 makes up this single bearish candle here. So that is how you can use the multiple time frame to, alongside with your candlestick, to predict your trade. So there is more to it, but at the introductory level, this is the basics of what you need to understand. So the candlestick communicates the language of the market. It is your duty as a trader to understand the language of the market before picking a trade. As I said earlier, I said if the market is going high, that's a bullish market. If the market is going low, that's a bearish market. Now, note something. I want to note something, that you can either make money when the market is going higher or going lower. Do you get that? So there is a saying I love to say, that the bulls make money, which is if the market is going higher, you can make money. The bears also make money. So if the market is going lower, you can also make money. But only the pigs get slaughtered. So who are the pigs? Those who trade without knowledge. And that's why OctaFX has brought this webinar to you, to teach you how to interpret and understand the language of the market using the candlesticks and the time frame. I hope you won't be the pigs after this, so that from this moment on, you become the bulls who make money and the bears who make money. Great. Yeah, back to my slide. Awesome. Yeah, if you have any question, just shoot me in the comment section. Just write them in the comment section. I would read them. So I will just quickly go through your questions and answer them. Awesome. Okay, someone asked a question. Does market price rejection also mean the price could not be sustained at that price? Yes. So when there is a rejection, as we can see here, let me use this as an example. When there is a rejection, you see that this price, it went up but could not be sustained, just like this person has asked. And because it could not be sustained, the market is pushing it down back to this level. So market rejection happens when price cannot be sustained at a certain level. Yes, at a certain level. Okay. Someone says more of this lecture needs to be organized by our broker OctaFX. Yes, more of it. You have more of it. Okay. Someone said, any other question? Okay. Someone said, what an interesting webinar. Hope more will be organized. Awesome. Thank you very much. We are glad to know that this is an interesting webinar, and that is why we want you to learn, get this knowledge firsthand. Okay, awesome. Let me go back to my slide while I wait for your question. Okay, someone is asking, how does one know a trend is about to turn around from a candlestick? Great. Now, as I've said that during the webinar, but I would come again. Now, I said the candlestick determines a lot. Now, when you want to know if the market is about to turn around, then you want to look at the body of the candle and also the shadows of the candle. Now, because the shadows of the candle can tell you a lot about the movement of price. Now, if you see okay, all right, okay, let me use this as an example. Awesome. Yeah, awesome, great. Great. So we can see from here. Okay, now from here you look at this candle. I'm talking about good, this particular candle. Now you see that this bearish candle, it opened above and closed below. Now, as I've said earlier on, let me delete this so our chart don't get too messy. Okay. All right, great. Now, I'm talking about, I want to use this bearish candle to talk about change in market direction. Over time, market has been rising, but it got to this level and things changed. Now you see this bearish candle here. Market opened at this level because previous candle on this 1 hour time frame was a bullish candle. It went up and closed. Now the price opened at this level, went up, the market rejected it, it went down, it closed below the previous 3 candles. It closed below the previous 3 candles. So you can see that it came so low and closed at this level. So which means this market opened at this level and closed above. This one too opened at this level and closed above. This one opened at this level and closed above. But this bearish candle opened at this level and closed far below the previous 3 candles. So this is also one of the ways you will know that the market is about to change direction. When the current candle closes, either if it's a bullish candle, if it closes far above the previous 3 candles, is an indication that what market is about to change direction. And as I've said earlier on, because your time frame also determines, the lower the time frame, the less significant the candlestick. So it would the candlestick on the 4 hours time frame speaks more volume, speaks more than the candlestick on the 5-minute time frame, because the 5-minute time frame is very messy. You see, it can jump up and come down at any time within 5 minutes. So it's so fast, and you might not be able to catch that the volatility at that short pace. But when you come to a higher time frame like the 4 hours, the weekly, the daily, the monthly, it tells you a lot of story. It tells you a lot of story. You get the point now. Okay, someone else is asking, please, how does one know? Okay, I've answered that. Okay, and that person says, you spoke a bit about range. What is the importance of range in trading? Awesome. Now, the importance of range in trading is only to indicate the distance via which a price moved. You understand? So okay, let's talk about this now. Let's use this to look at the price range. So because price range, let me zoom in a bit. Awesome. So price range looks at the price, the higher shadow, the price of the higher shadow. Okay, I have a trade open there. The price of the higher shadow here, and the price of the lower shadow. So you want to look at, okay, at what distance did the price move? If it is like this bullish candle, as we can see here now, we are looking at it that, okay, the price opened at the lower price was at 1.11813. Then the high price was at 1.19129. That tells you the distance. So when you now subtract this one, the 1.118 from the 1.191, it will tell you that the price of how far the low price is from the high price. It tells you the distance between the low price and the high price, and of course the distance between the low price and the high price is very important to you as the trader, because you want to know how far did this price jump, if it's a bullish candle, or how deep did this price fall. Do you get that now? So that shows that it is very, very important. Okay, someone is asking, please, when is the next lecture? Okay, don't worry, we'll get back to you. We'll get back to you. He said this is interesting. We'll get back to you about the next lecture. Let me go back to my slide as we proceed from here. So I've explained basically everything on my slide down in the live chat. Now, because I said the longer time frame typically contains fewer and more reliable signals, exactly what I said, and then the shorter time frame usually comes with less accuracy. As I've said, the lower the time frame, the less significant the candlestick. The higher the time frame, the more significant the candlestick. I believe you catch that. Great. There are several types of traders. They have different trading styles. There are swing traders, position traders, that prefers to hold their trade for days, week, and some months. They mainly focus on the daily chart. So some persons will just open a trade on a daily chart and leave it for weeks, for months. They can also make use of a weekly chart when defining a long-term trend. The higher the time frame, it helps you to predict a longer price movement than a short time frame. So it depends on you. If you want to track your price movements in a lower time frame, probably you want to trade you want to do intraday trading, you want to trade within a day, you can use the 4 hours chart. The link is in the description below, and you have to take advantage of it. How do you take advantage of it? You make any deposit and check your bonus. Apply for the bonus. Just click apply for bonus. Once you've made any deposit, this would expire on or before the 22nd of April. It will expire on the 22nd of April, and you don't want to miss it. Go and apply. Thank you very much. I believe I've answered majority of our questions, and I'm glad to have each and every one of you on this webinar. Thanks for joining OctaFX. Thanks for choosing OctaFX. Thank you very much. Thank you.